This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, April 7th, 2016. Euro dollar. So the euro surge has continued this week with the market breaking to fresh 2016 highs, clearing the previous high from the previous week at 114.38. This now opens the door for the next upside extension towards key medium-term resistance, which comes in the form of that high that we saw initially going all the way back to May 15th of 2015 at 1467, and then above there, looking at the high that we saw going back to October of 2015 at 114.95. So there's some key resistance that comes in now ahead of 115, above which would then expose critical resistance all the way up by that high from August of 2015 at 117.09. So clearly now the pressure remains on the top side, but again, the market is coming into some significant medium-term resistance towards 115. At this point, we would need to see a break back below the low that we saw on Wednesday, which came in at 113.27, to take the immediate pressure off the top side. Sterling dollar. So cable remains pressure to the downside overall, though the market did recover a little bit off those lows that we saw, those extreme lows from Wednesday at 140.05. At this point, though, the market remains pressure to the downside, and there is risk for deeper setbacks below 140 towards the 7-year low that was established earlier this year back in February at 138.36. At this point, a break back above 145.15 would ultimately be required to take the pressure off the downside. Dollar yen. So dollar yen continues with its impressive declines. The market has now broken down well below 110 and is focused on extending this next downside extension towards a measured move, which comes in the 106.50 area. At this point, any rally should be very well capped by that previous 2016 low support, now turn resistance at 110.67, while ultimately only back above 115 would really compromise the current intense downtrend in dollar yen. Euro Swiss. So Euro Swiss remains well supported on dips. Overall, the market has been trading within a confined consolidation, but ultimately the broader recovery structure remains intact, and a fresh upside extension is favored beyond recent 110.24 highs back towards the multi-month peak at 112 further up. Only a break back below recent lows at 108.10 would compromise this constructive outlook for Euro Swiss. Aussie dollar. So Aussie continues to consolidate off recent 2016 highs, though it's unclear at this point whether the market is looking to put in some form of a top ahead of the next major downside extension, or is looking to continue to extend its gains beyond 77.23 and towards the next key medium-term resistance at 78.50 further up. A break back below 74.77 would be required to take the immediate pressure off the top side. Dollar CAD. So dollar CAD was showing signs of a potential double bottom the other day after the market put in a low at 28.58 and started to recover. However, we've since seen some setbacks in recent trade that keep the overall pressure to the downside. While the market holds below 132.96, which was that proposed neckline, the pressure does remain on the downside, and there is risk for deeper setbacks below the recent 2016 low at 28.58. At this point, again, a break back above 32.96 will be required to take the pressure off the downside and suggest the market is looking to put in some form of a meaningful base. Kiwi dollar. So Kiwi has been bid back up off recent lows, but overall the market has been trading lower since posting a 2016 high in the previous week at 69.67. Ultimately, on a medium-term basis, there's some formidable resistance ahead of 70, and so while the market holds below 70 on a medium-term basis, the pressure does remain on this downside, and selling rallies should be the preferred strategy. At this point, though, a break back below the low that we saw on Tuesday, which came in at 67.59, would be required to put the immediate pressure back on the downside. SPX 500. So the S&P 500 is showing signs of a potential exhaustion from that rally out from February lows at 1808, and the market is expected to put in a medium-term lower top now somewhere below 2100 and below that record high from 2015 ahead of the next major downside extension. But it will take a break back below 2021, the low that we saw on the 24th of March, to strengthen this outlook and accelerate declines. Again, only a close back above 2100 would negate this newly adopted bearish outlook for the S&P 500. Gold. So gold has seen some consolidation in recent trade, but looking at the weekly chart, the market is expected to continue to consolidate ahead of what should be the next major upside extension, while the market holds above some previous resistance now turned support at 1190. This upside extension should take the market back to fresh 2016 highs and for a retest of the 2015 peak at 1307 further up.